Hi everyone. I only have one slide, a statement by Ben Bernanke that is there to taunt you. I want to say, and I need to add ironically lest you start walking out the room, that I'm here to say hats off to the neoclassical economists and those who regulate by its edicts. What do I mean by that? Well, let me put it this way. We've had in the last few years what we could call a financial rumble in the jungle. For those of you too young to remember, the original rumble in the jungle was that world heavyweight boxing title fight between Muhammad Ali and George Foreman held in Zaire. The current rumble in the jungle sees that a couple of years ago, the bankers were on the ropes. They had lost billions, they'd been bailed out. They were being pounded and humiliated in congressional inquiries. Greenspan confessed to a flaw in the model by which he understands the world, and the world gasped. What a confession, everyone thought. But, as we return to the original rumble in the jungle, while Muhammad Ali was being pounded and leaning back on the ropes, he was saying to George Foreman, "George, is that the best you've got? George, can't you hit any harder?" And of course, as the congressional hearings died away, the bankers came back the way Muhammad Ali came back. What we've seen since the congressional inquiries died and the regulatory agenda has been back on the platform is the bankers are back, the old regulations are back, the bonuses are back. While we aren't back exactly to where we were, we would have to say, if it were a world title fight, that the bankers won. Greenspan said in a Financial Times opinion piece last week that we should rely on the global invisible hand and that an irredeemably opaque financial system might be a necessary condition of growth. So Greenspan's statements in combination are telling. There is a flaw in the model, yet the system of free market, global invisible hand, opaque finance is the way to go. There may be a flaw in the model, but whoever said models are or need to be flawless? There have always been flaws in the model. Bob last night mentioned the Cambridge capital debates, those debates between Cambridge, Massachusetts and Cambridge in England about how to measure the value of capital. And the conclusion of that debate, not that there was a conclusion, but for those of us who sided with Cambridge in England, the conclusion of that debate was the valuing of capital is entirely circular. You can't know the present value of capital without knowing its rate of return, and you can't know its rate of return without knowing its present value. There is a circular logic there. But, and this is the key point, even though you can't measure the value of capital, it hasn't stopped capital over the last 200 years undertaking a precise process of measurement. The calculative project goes on even though it is logically flawed. So in a sense then, my second point of admiration of our mainstream economic colleagues is that financial economics has not just been about practicing the hegemony of finance, it's also been about building that hegemony and transforming its analytical devices such that they can cope with and accommodate changes in capital itself. The way I want to address this question for the next 20 or so minutes is via a consideration of the concept of fundamental value. That idea that in markets or in market valuation, there will be gravitation to some true, normal, underlying condition that in a sense is said to reflect real conditions. Here we have the Bernanke quote, "The notion that financial assets can always be sold at prices close to fundamental value is built into most economic analysis, and before the crisis, the liquidity of financial markets was often taken for granted." So, with this concept of fundamental value that Bernanke still holds to, and indeed the economics profession still holds to, let's start with some obvious points of criticism. It's a fraught category. It's developed and it lives inside the idealised world of perfect competition. It has a framework that makes a whole series of ceteris paribus assumptions, and it operates in the contrived domain of partial equilibrium analysis. It's economistic in its understanding of exchange, it's reductionist, it's deterministic. Our friends in discourse analysis would say it is constructed in the language of individualism, the language that embraces competition and impersonal markets. It naturalises market relations, and in so doing, there is a lack of explicit consideration of the social contexts within which markets operate. It is a deeply flawed category. But despite all these criticisms, despite all these obvious flaws that so many of us here are aware of, it remains, in analysis, a powerful category. And it's powerful not because it's fixed and canonical, although Bernanke would in a sense like us to believe it's a canonical category with a long lineage. It's powerful because it is a fluid and evolving category. The point is that fundamental value and the notion of prices moving to fundamental value is the way in which capital commensurates itself, the way in which capital goes through the process of determining its relative valuation so as to work out where the best rate of return is and where the next dollar of investment should go. As capital has evolved, so too has the way of thinking about the pricing of value, the thinking of how to calculate where that next dollar of investment should go. The particular evolution in the concept of value that I want to focus on is the development in the form of finance since the 1970s and especially the 1980s, and to be specific, developments in derivative markets. Because with derivative markets, capital has been breaking through the boundaries of its own self-description and its own self-measurement. In particular, what makes derivatives important in this context is that they constitute a form of ownership of exposures. Lynn last night referred to derivatives as bets. Now, they are bets, but another dimension of them is what do you own when you own a bet? You own exposure to the performance of an asset, but you don't own the asset itself. By that ownership of an exposure, you acquire a rate of return, but a rate of return that is divorced from the underlying asset. With that change, with the rise of that new concept of ownership and a rate of return on something different, on something that is not an asset constituted in the old way of assets, we see that the original notion of true value, fundamental value, as it was conceived over the previous 200 years and indeed in neoclassical economics until the 70s, that notion is now being superseded. But it's not gone, that original notion of fundamental value. Indeed, it should be said, or should be noted, that that original concept of fundamental value is now just one possible interpretation of how markets work. Trading on the basis of fundamental value is now just one particular strategy utilised by hedge funds and investment banks. Warren Buffett trades on the basis of fundamental value, or what he calls, following his mentor Benjamin Graham, the father of securities analysis, Buffett trades on the basis of the principle of intrinsic value. That is, you look at the company's balance sheets, you look at other information about the performance of the company, you get the fundamentals, the external information, you get a discounted present value, a future value of those companies, of that company's stocks. You then work out at its current price, is it undervalued or overvalued? Is it a good buy? Is it not a good buy? So Buffett employs fundamental value. George Soros used fundamental value analysis, a global macro strategy, when he bet against the Great British Pound, the Yes, the Great British Pound in 1992 and the Thai Baht in 1997. But the point is, while fundamental value as a concept of analysis may be in use, it is but one strategy that sits alongside other strategies by which to analyse data and a whole lot of other strategies by which hedge funds and investment banks take positions in financial markets. But my point here is not simply that there are now many possible strategies and that fundamental value is just one particular strategy. I am making that point, but I have more to say. When we notice that the concept of fundamental value in its old sense has been marginalised or pushed to the edges as a possible strategy, a new concept of fundamental value emerges. Because there is not, and Bernanke is showing that in this statement here, there is not the loss of interest in foundational measures. To repeat, if capital is going to commensurate itself to work out relative values, it needs to be able to determine relative values, and it needs to be able to do it precisely. With the rise of derivatives, the calculative process has changed, and with it, the concept of fundamental value has changed. So what is this change that I'm here talking about? Well, the change really I want to identify as having two basic, simple elements. First of all, with derivatives, we see the rise of what could be called self-transforming capital, and also associated with it, the rise of the search for yield. By self-transforming capital, I mean the capacity that comes with derivatives and associated computer technology to continually change the form, the location, the form and the location of capital, because capital itself is not embedded in an underlying asset. A treasury bond can be converted into a treasury default swap and that into a foreign exchange option at virtually no cost and virtually instantaneously. The search for yield follows accordingly. The appropriation of returns from whatever forms of capitals, activities, markets and locations proves profitable is what drives the investment decision. But of course, yield can't be evaluated and commensurated without some measurement of risk. So risk itself comes to the fore as an integral component of measure, and for commensuration to occur, risk must be defined as precisely as yield. In this framework, the decided feature of capital is not the old conventional notion of stocks, the value of corporate assets, and the calculation of the present value of corporations. It's a flow concept of value. And a flow concept of value, as Karen has talked about for a number of years now, seems to be that which captures the derivative form of value. In a flow concept of value, risk itself becomes both more complex to calculate and more integral to the process of calculation. So what defines capital, therefore, in this current era is its permanent movements, its shifting forms, locations, temporalities and markets in search of opportunities to create risk-adjusted yield. So, to come to the measurement of fundamental value, calculations like, or techniques like, the efficient markets hypothesis, the capital asset pricing model, Black-Scholes options pricing model, value at risk. These are all finance's attempts, or the class of capital's attempts, to undertake a process of commensuration in recognition of the complex forms and risk profiles of different forms of capital. As critics of these sorts of techniques, of the efficient markets hypothesis, CAPM, value at risk, etc., we all get excited about criticising them for their assumptions, for their accuracy, for their performativity, for their prediscursive categories. But the critical point is, even though they are flawed, they are capital's project. They are the way in which capital commensurates itself. No matter how flawed it is, these are the models that are being used. So, Let me make then a few points in relation to this. First of all, in the context of liquid markets, a flow measure of value, liquidity is the key to the measure of value. In a world of leverage and derivatives, the danger of a financial crisis is that asset markets are prone to suddenly drying up. As asset holders drop markets to make positions, the fear is that there will be insufficient buyers to secure fair or true price. That's exactly Bernanke's statement right there. We saw in the global financial crisis in this context that central banks then suddenly had a great idea. They stepped in and injected liquidity by buying up mortgage-backed securities. In that crisis, a new convention of central banking was emerging, in which central bankers would start to become the market makers of last resort. That is, an emerging orthodoxy that is starting to appear inside central banks, that's in the Bank for International Settlements literature, Reserve Bank of Australia literature, Bank of England literature, is they are probing the possibility of, in a future central banking regime, i.e. a very immediate future, they will hold reserves of and trade in a vast range of financial markets to ensure that prices don't crash below fundamental value due to short-term illiquidity. Notice the slide in the meaning of fundamental value that then comes into play. If the state, through this new initiative, becomes the market maker of last resort, it means that markets will be made complete in the sense that Woody talked about complete markets last night. Markets will be made complete by the state. The state then steps in to become the determiner of fundamental value. That's essentially the logical corollary that follows from Bernanke's statement up there. Notice, if this were to happen, if this does play itself out, that the state becomes the determiner and the maker of markets and therefore the provider of fundamental value, the state will again anchor finance. This concern that finance has become separate from the state is abated. But it becomes the anchor of finance, not by providing an external, independent regulatory process, not by sitting outside financial markets and overseeing, but by being inside and underwriting. In the process, though, the state will be rebuilding the explanatory capacities of capital's calculative devices. CAPM, value at risk, etc., will move back into prominence because one of their key flaws, that they can't deal with illiquidity, they can't deal with that prevalent uncertainty, that clear flaw will have been abated or dealt with. Second general point then that I want to draw out of this analysis, and it relates to Marxism, a body of theory from which my insights derive. Financial calculation, since the rise of derivatives and since the rise of CAPM and value at risk, etc., financial calculation has been delivering to Marxism the concept of capital as the social relation of value in movement. As Marxists, we all invoke this phrase, capital is the social relation of value in movement. That's precisely what the capital asset pricing model, value at risk, are trying to do. But instead of embracing this notion that we are being delivered with a unified concept of capital in movement, Marxists, but not just Marxists, the liberal critics as well, have wanted to unpick capital. We've wanted to say, in the context of the global financial crisis, the critical issue we want to understand is which part of capital is real, which part is fictitious, which part is speculative, which part is hedging, which part is productive, which part is unproductive. And my proposition to you is, if as Marxists we are opposed to capital, we have a view of the world that we want to go beyond capital, Why is all this energy being put into unpicking different sorts of capital, as if some forms of capital are virtuous and others aren't virtuous, when really our object has been to move beyond value? Marxists, I put to you, have been stuck in stock measures of value. Socially necessary abstract labour time is a stock measure of value. And Marxism needs to develop flow concepts of value if it wants to understand how capital works. No wonder then Marxism has been so impotent in the context of the global financial crisis. Its agenda has been, in those commentaries on the crisis, not about going beyond value, but in reconstructing value. So, what does a positive, progressive Marxism look like as we think of Marxism in relation to the concept of value and the measurement of value? Well, I want to draw just a very simple conclusion. Just as in the era of stock measures of value, excuse me, Marxists understood value in terms of labour. Socially necessary labour time, labour as the source of surplus value. Marxists could say, and I believe rightly, the problem with the neoclassical measure of value was labour was written out of the measure. Labour just became an incidental part of a stock measure of value. And as Marxists, I'd say, we know, I have a strong sense, the history of capitalism had to be understood in terms of the appropriation of surplus value, the particular class relation between labour and capital that went into the creation of value. We now see in flow measures of value that labour there too has been written out of the creation of value. Yet just as labour was important in production as labour power, so labour is important in finance. Labour is important in finance through credit relations, households as savers, workers as borrowers, through pension funds, where every pay period something comes out of your wage and gets eventually via a mediated process put in there for traders to invest in the market. And perhaps even more importantly, labour is integrated into finance because labour's income is the basis of the largest growing form of securitisation that we saw in the previous 10 years. That is, labour's income that goes to mortgages, to pay student fees, to pay auto loans, credit cards, health insurance. All of these income streams have been securitised. Yeah? The income stream goes into products that get packaged and sold into financial markets. So out there in financial markets, what is owned is not the mortgage, but the income stream on the mortgage. Not the health insurance company, but the income stream on the health insurance. These have all been securitised, sold into markets, and markets have devoured these products. Why? Because markets want exposure to labour. They believe households are a stable, labour in households are a stable source of investment. Now, we got that wrong, or they got that wrong, because they thought that labour would keep repaying debts even when labour was presented with contracts that couldn't be repaid, the crash of mortgage-backed securities. It reveals that labour is critical to financial stability and critical to the valuation of capital. In the era of stock measures of valuation of capital, we talked about labour's political capacity through industrial action. In the era of flow concepts of value, we can talk about labour's potential political capacity in intervening in and interrupting and transforming financial accumulation. Thanks a lot.